Monday, we talked about the central banks, singular central banks in other countries, and the Federal Reserve System in the US and how they're so distinct. We talked about how central bank individualized central banks can have branches, and however, they are branches of a unified one single central bank in many other countries. Except in the US, we have the Federal Reserve System, where you have 12 almost independent um, Federal Reserve banks. They have their supervision and regulatory power over the designated areas. And then you have one governing body for entire 12 bank system. And therefore, even though it is a unified system, you still have rather, specific um, duties assigned to these individual reserve banks and obviously their independence. So, and because of this uniqueness, I think that it is a quite an interesting case when it comes to central banks, and it is an effective system, and it seems to be working. And recently, the European Central Bank adopted a structure very similar to the U.S. Federal Reserve System, and it seems like this would also work for a union like the European Union, where you have individual countries that may need their pseudo independence with respect to their monetary policy. And then I use the term pseudo because the European Union has one, or the Eurozone has one currency, and therefore, there cannot be individualized monetary policies. However, the implementation of policies in individual countries with respect to, the budgets and the budget implementation, balance of payments, and then the banking regulations can also have interactions where the individualized central banks, localized, individualized central banks may need to be, unique to that area. And I think that's the idea behind the Federal Reserve System's dispersed system, where you have these regional central banks, and then you have the Board of Governors. So with that, we said that the Board of Governors had 7 members, and these are nominated by the president, and then the U.S. Senate will confirm them. And the duties of the Federal Reserve System include the open market operations, the discount rate, the reserve requirement, and these are very specific monetary tools to implement the Federal Reserve System's monetary policy. The ultimate aim, obviously, is to provide the safety and security of the financial system, the banking system per se, and to maintain an economic growth and a stable economic growth, and to maintain a stable currency. So, on Monday, we talked about, the sub institutions of the Federal Reserve System, the controller of the currency, and et cetera. And therefore, I think that within the purview of the responsibilities, just saying that, they have to maintain an economic balance and economic stability, that includes significant work. So anyhow, so today we're talking about the Federal Open Market Committee. And it's really interesting because you have the 12 banks and you have the Board of Governors, but then you actually have a committee that's quite unique to the Federal Reserve System, and that is basically responsible for the open market operations of the Federal Reserve System. And while the Board of Governors are elected for 14-year terms, and they can only be elected only once, and you actually have 7 governors, and remember, we have 12 reserve banks. We have in the Federal Open Market Committee 12 voting members. Now, these voting members include the 7 members of the Board of Governors by default. So if you're a Board of Governor, you are a voting member of the FOMC, which means that these 7 members are members of the FOMC for 14 years. Then you have, we talked about how special the Federal Reserve Bank of New York is on Monday. And we said that because most of the banks, or the large banks, have their headquarters in New York. And therefore, this makes the Federal Reserve Bank of New York rather special compared to the other 11. And therefore, that special place of the Federal Reserve Bank of New York is recognized by having a permanent seat, a voting seat on the FOMC committee, or the Federal Open Market Committee. So you have 7 plus 4, that's, I'm sorry, that's 7 plus 1, that's 8. And then you have 12 voting members, therefore that leaves you with 4 remainder seats. Now, these 4 remaining seats are basically filled by, on a rotating basis, by the remainder 11 Federal Reserve Bank presidents. And each one of them, on a rotating basis, serve 1 year. So everybody gets a vote. And but it's just every year they have to wait their turn to be on that committee. However, during the meetings, all of the Federal Reserve Bank presidents are present, and therefore it's an inclusive discussion. And we usually get the minutes of these discussions publicly, and that you can actually see that everybody has a say. However, when it comes to voting, only voting 12 voting members. That's the 7 board of governors in New York, and then rotating the remainder 4. So while the FOMC can determine its own internal organization, traditionally FOMC elects the chair of the board of governors as its chair, meaning if you are the Fed chairman, you're also the chair of the Federal Open Market Committee by tradition, not by law. So, and then you actually have the Federal Reserve Bank of New York as the vice chair, and again, tradition. So we have about 8 meetings a year or as needed, and we meet in Washington, D.C., and to decide what sort of open market operations we are going to do. So we'll talk about these, transactions, and there are some that are very unique and that has been happening in the past. And but the operations affect the federal funds rate, and then the overall monetary and credit conditions and aggregate demand, the entire economy, and so on and so forth. But there's some history that was recently changed, and that's why I've actually emphasized the tradition part of this. Even though the FOMC is a very traditionally run committee, its actions for the past 20 years have been rather revolutionary. So we'll talk about that in a minute. So overall, the Federal Reserve controls 3 tools of monetary policy. The first one is open market operations, the discount rate, and the reserve requirements. So the open market operations are the purview of the FOMC, and we'll talk about it in a minute. However, through open market operations, it is actually possible to have the same effect as changing interest rates, or changing the amount of liquidity in the market, or changing the foreign exchange policy. So while the open market operations may seem like a restrictive duty and ability, they actually are quite, the repercussions of these actions can be quite wide, and they can actually extend to changing or serving the ultimate purpose of the Federal Reserve overall. So it is a very important committee, and I think that's why, we actually get to listen to them every time they meet, and then we get to read their minutes every time they meet, and it's a very influential committee. So with respect to the reserve requirements, we'll talk about this in the next few weeks, but through the reserve requirements, the Fed can control the money creation, and they can also maintain banking security and safety. And through, we talk about this, when we talk about the basal banking, I don't want to say regulation, but rules. And one of the ways that the supervisor or the regulator serves the economic growth or economic control is through reserve requirements. By requiring banks to have more reserves for given risk categories for their asset classes, you basically disallow higher risk taking. By lowering the reserve requirements, you allow banks to take more risk and therefore expend more and create more money and create more business funding, create more money, create more liquidity. The discount rate, Fed is, or the central banks are in general, lenders of last resort. We talked about the London interbank offered rate, which is, when the large banks have intraday needs or overnight needs, they can borrow from each other using the fixed or daily fixed LIBOR. And however, in every country, you have a central bank who will be the lender of last resort. So if a bank cannot borrow through LIBOR or through its own means, they can always come to the Fed window or the central bank borrowing facility. It's usually a little more expensive, and you may have to explain why you have to resort to that. However, through the discount rate or through the actual lending operations of the central banks, you can maintain your liquidity overnight or for very short periods of time. In the US, though, Fed has been using the discount rate quite effectively, especially after the 2007 financial crisis. And it's a crisis that continued over 2007 all the way to 2010, and afterwards we actually had a significant continuation of Fed interventionist policy and therefore the open market operations. So that's why I wanted to emphasize that open market operations can also have a significant extension to how the Fed can create more liquidity in the market and how the Fed can inflict rather short or less liquid market, right? So let's talk about that a little bit, and then we'll get back to the repercussions of such long-term open market operations policy. So let's look at an example of what an open market operation is. And remember, through these operations, the Fed actually is a lot more interventionist, and it almost acts like an actual bank. And one of the things that we have seen, especially in 2000 or post 2007 financial crisis, is that Federal Reserve started to buy back bonds, right? So think of it this way: when a government needs to borrow funding, when the government needs money, they issue a bond. So the Treasury is the issuer of the bond. But they do it through the Fed, and the Fed basically sells these bonds for the government. So think of it like every time a bond by the government is sold to an individual in the country, the individual pays cash to buy the bond. So you basically are paying cash out of your pocket, and you're getting a paper instead that stays in your wallet or in your brokerage account. And the idea is, if you don't have that cash, you cannot spend it. You cannot, pay anything. So you simply don't have the cash. And therefore, if the government actually issues enough bonds, you could actually drain cash or spending cash out of the economy. And in the long run, this creates a liquidity problem, because if everybody invests in bonds and nobody has cash, then consumers simply will not be able to spend money. And if we cannot spend money, businesses can't sell. If businesses can't sell, they cannot employ people. And if they cannot employ people, well, then we get fired and we don't have any money to spend. So it's a dead end. So there has to be an optimal level of how much bond to issue. and how much money to drain out of the economy. So, I mean, it's a very simple system. If you've actually replaced money with paper that people cannot spend, then you're losing liquidity in the economy. So, how do you fix it? So, in 2007, when we had this mortgage-backed security or variable interest rate mortgages crisis, when the market collapsed with Lehman Brothers first, AIG second, and last week we talked about these. And one of the issues that the Federal Reserve had was that, or one of the tools that the Federal Reserve Bank had, the Federal Reserve had, was to lower the interest rates. And that's what they did. They actually lowered it so much that by 2008, the interest rates were effectively very close to zero. So, which means that the Fed was literally um, giving the money or lending the money away to financial institutions in the hopes that the financial institutions will pass it on to consumers. And as we have access to low cost borrowing, we can spend the money and create business activity, and businesses can sell and generate revenue, and then the entire economic recession would end, and we would have economic activity, economic growth, which is a great idea. But the problem was, even though the interest rates were zero, we still didn't have that intended activity. So how could you actually extend that even further when the interest rates are actually zero? So in Europe, we have seen many countries going into negative interest rate territory, say in Germany, for instance. And with a negative interest rate, you basically are selling bonds at a discount. I'm sorry, at a premium. And that people are actually buying bonds and by paying more than the face value. And therefore, just for the safety of it or hoping that things will change, but creating, in effect, a negative interest rate, meaning the government was actually giving people and paying people an over interest so that they would borrow, so that they would spend, and then the business cycle could start. But for many years, they continued this, and the extension of that 2007 crisis in the US, or the spillover of that crisis in the US to Europe and the other developed nations and developing nations alike, um, even the negative interest rates did not seem to resolve the situation. So through open market operations, the FOMC purview, the Fed actually started buying back bonds from the market. And they call this quantitative easing program. So, and just as I explained, if you issue a bond as a government, you're taking the cash out of the system and you're replacing it with paper that individuals cannot spend. You cannot go to Walmart and buy bread with a bond, right? So you need the cash. But if you use the cash to buy the bond, then you don't have that ability to spend it anymore. So what Fed did was they literally, through the open market operations, bought back bonds on a continued basis every month, a few $billion, which the amount changed from month to month. And then we had quantitative easing number one, quantitative easing number two, quantitative easing number three. So different programs through the FOMC, and they just kept buying back these bonds. And this actually created liquidity in the market, meaning you're buying the bonds. The Fed is buying the bonds from individuals and leaving cash in their hands that they can spend this money. So this, on top of the zero interest rates, created a lot more liquid economy, and therefore that allowed banks to lend more money, and that allowed individuals to spend more money. Now, remember, when you have a bond as an individual, like I said, you don't have the cash to spend. But if you, sell the bond, or the Fed buys the bond from you, then you now have cash to spend. Very similarly, from a bank perspective, if your balance sheet is full of bonds, then you really don't have to lend to any other borrower because you lend it to the government. So why would you bother lending money to individual companies or individual retail borrowers, which you would need to do a significant analysis and cost, and when the government can borrow from you at a great expense. So when the Fed starts buying these bonds from individuals and institutions alike, then the balance sheets now lose this significant amount of bonds from their balance sheet, and that leaves cash in the hands of institutions to lend more money, in the hands of individuals to spend more money. And this example that I have here shows large scale asset purchases, and then you can actually see the first round was 2008, 2010, and they include about 175 billion dollars in agency debt, and I mean trillions of dollars. I mean, and if you go through, say, the second round, we again have about a $600 billion in longer term securities. So all in all, I think the approximate amount was a little over $3 trillion. And then the third round was in 12 to 14. So this obviously creates a significant balance sheet for the Federal Reserve. I mean, remember, you as a Federal Reserve system, you're actually now buying these bonds from these institutions and individuals, and all of a sudden, these bonds are in your balance sheet now. Now, remember, these bonds belong to the government, to the Treasury. So when the Federal Reserve buys these bonds, now Federal Reserve owns these bonds. However, they're issued by the Treasury. So they end up with having a significant balance sheet for owning these excessive amount of um, Treasury bills, notes, bonds. So when we talk about the open market operations for the Federal Reserve, the issue again is that while it involves like currency buying and selling, bond buying and selling, and then like literally the open market operations where the Fed becomes almost like an active bank, an interventionist bank, and they try to influence or implement policy through their operations. And even though the discount rate and the reserve requirements are not their purview, um, through their operations, they can actually implement um, activities very similar to the quantitative easing example that we talked about, that would have very similar results as changing the interest rate. Like, for instance, when the interest rate was set down to zero, and the Fed just simply didn't go to negative territory, and they simply started buying back bonds. So buying back these bonds had an impact of creating more liquidity, which has the same result as having lower interest than even 0%. So the quantitative easing actually was used by many other um, countries. However, the idea of quantitative easing. So, however, this was actually an issue when in 2010 and 11, as far as I remember, that when the Greece had a financial crisis, and the European Central Bank wanted to help Greece, but then the question was, they didn't have an actual European treasuries to issue for Greece or to buy back from Greece, and therefore they simply were not able to conduct such a unified action for Greece. And instead, they had the Troika, the IMF included, to help Greece. So, in the sense that the Federal Reserve system can, through the Federal Open Market Committee, intervene to the market through their open market operations, is rather unique. So another unique activity, and by the way, you can actually see also Federal Reserve Bank of St. Louis, they have this explanation as to how well does it work, and they explain, and I'll provide these links with the um, with today's video on today's content. But there was another issue that was quite interesting, and that goes to the Open Market Committee um, operations and hearing this. So the Fed is buying some of the biggest companies' bonds and raising questions over why. So, we said how the Fed is, and this is 2020, and this is right after the COVID, and during that time, the Fed was very dovish monetary policy, and their intent was to restart the economy from everybody hunkering down to let's work, let's have more money, let's have zero interest rates, and one of the ways that they did this was they didn't want it to reignite the quantitative easing, but one of the ways that they did it is to buy back. Well, I shouldn't say back, buy corporate bonds. It has the same impact as buying treasuries. However, this also, creates better, you know, um, questions as to why not just buy treasuries? Why would they need to buy corporate bonds? But I think that at that time the corporate bond pricing was so high, and even the Fed buying more just exacerbated the issue. And even though interest rates were all almost in the negative territory for largest of companies, and Fed buying just made things a little bit worse. Obviously, see, they also actually talked about the moral hazard, and is this ethical for the Fed to intervene into the corporate bond buying system? So, and this is another example by Fed that they talk about secondary market corporate credit facility. Again, so this is an example of the operations of the Federal Market Committee, um, and they are revolutionary in the sense that we don't really see this sort of activity by any other central bank, as far as I know, and that the Fed has been pretty interventionist with respect to or through the FOMC since the 2007 crisis. Did it help? Well, we've recovered significantly in our financial markets, especially in the stock market. Our yields are significantly lower compared to 2007 and immediately prior. And we went through a COVID economy, and the inflation is being rather controlled. At least it's not double digits yet, and therefore it appears to be working. However, this leaves the Federal Reserve with a significantly inflated uh, balance sheet, and we'll probably see if there will be any long-term hazard to Fed and therefore hazard to the overall economy. But I wanted to give you some examples of how this FOMC operations work and why they are important. I will provide these links with the current discussion content on Canvas. And thank you for working with me. I really appreciate it. And let me know if you have any questions. And thank you so much. Bye for now. Hope to see you soon.